Hello everyone, what is regulatory risk? Regulatory risk is the risk that a change in laws and regulations will materially impact a security, business, sector, or market. A change in laws or regulations may be the government or a regulatory body can increase the costs of operating a business, reduce the attractiveness of an investment, or change the competitive landscape in a given business sector. In extreme cases, such changes can destroy a company's business model. Key takeaways: regulatory risk refers to the risk that a change to the laws or regulations will hurt a business or investment be affecting that business, sector, or market. While often necessary for the public good, government regulations can increase the cost of doing business or limit prospects for further growth, cutting into profits and hurting the return on investments. Understanding regulatory risk: virtually any business can face significant regulatory risk, given any government's power to compel businesses operating within ETS borders to follow ETS laws. Regulatory risks often materialize as a result of anger over a public harm caused by a business or business sector. But even if new laws are never passed, business leaders are obligated to assess and monitor regulatory risks and be prepared to react if they do materialize. This can be time-consuming and expensive because regulatory risk stemming from even one issue can drag on for years. Examples of regulatory risk: one sector facing significant regulatory risk in the area of antitrust enforcement is big tech, including Facebook, Amazon, Google, and Apple. This is largely the result of a growing public backlash over their enormous and still growing market power and social influence. Past examples of regulatory risk that materialized include the introduction of the 2002 Sarbanes-Oxley Act, which established more stringent accounting requirements and more severe criminal penalties for violating securities laws. It was passed following public outrage over multiple accounting scandals in the early 2000s, including those of Enron Corporation and WorldCom. What is foreign exchange risk? Foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuations. Also known as currency risk, FX risk, and exchange rate risk, it describes the possibility that an investment's value may decrease due to changes in the relative value of the involved currencies. Investors may experience jurisdiction risk in the form of foreign exchange risk. Foreign exchange risk. Understanding foreign exchange risk: foreign exchange risk arises when a company engages in financial transactions denominated in a currency other than the currency where that company is based. Any appreciation/depreciation of the base currency or the depreciation/appreciation of the denominated currency will affect the cash flows emanating from that transaction. Foreign exchange risk can also affect investors, who trade in international markets, and businesses engaged in the import/export of products or services to multiple countries. The proceeds of a closed trade, whether it is a profit or loss, will be denominated in the foreign currency and will need to be converted back to the investor's base currency. Key takeaways: foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuations. Foreign exchange risk can also affect investors, who trade in international markets, and businesses engaged in the import/export of products or services to multiple countries. 3 types of foreign exchange risk are transaction, translation, and economic risk. Bij Julia Kagan, updated July 23, 2021. Fact-checked by Michael Logan. What is macro risk? Macro risk is a type of political risk that can impact all businesses operating within a country. Macro risk can be political in nature or caused by macroeconomic factors outside of government control. Common examples of macro risk include changes in monetary policy, shifts in the regulatory or tax regime, and political or civil unrest. Key takeaways: macro risk is a type of political risk that impacts all asset classes exposed to a particular country or region. Macro risk can be political in nature or caused by macroeconomic factors outside of government control. Companies can guard against macro risk by purchasing political risk insurance to mitigate potential losses. Understanding macro risk impacts all asset classes that are exposed to a particular country or region. Imagine a country, for example, that has elected a government opposed to foreign influence and interference. Any company that engages in foreign direct investment, FDI, or has operations within the country would face tremendous macro risk, because the newly elected government could expropriate any and all foreign operations, regardless of industry. Many organizations and academics issue reports that assess a country's or region's degree of macro risk. Furthermore, companies have the opportunity to purchase political risk insurance from a variety of organizations to mitigate potential losses. Macro risk and the impact on the market. Macro risk is both a short and long-term concern for financial planners, securities traders, and investors. Some of the macroeconomic factors that can influence macro risk include unemployment rates, interest rates, exchange rates, and commodity prices. Some macro risks will have a greater impact on a particular sector than on others. Changes in environmental regulations, for example, tend to impact the mining and energy industries more than other industries. However, the repercussions for these industries can then ripple through an economy if mining and energy are significant sources of investment and jobs. Unemployment rates, interest rates, exchange rates, and commodity prices are macroeconomic factors that can influence macro risk. Macro risk is an important factor for stock traders and institutions to consider in their financial and risk models. Most macro risks are addressed in valuation models like the arbitrage pricing theory, APT, and the modern portfolio theory, MPT, families of models. Valuation models and closely related fundamental analysis models also consider macro risk as a factor. Understanding how macro risk influences the intrinsic value of a particular investment is important because when the factors change values, errors can be introduced in the corresponding intrinsic value forecasts. Macro risk and international investment flows. Investors also look at macro risk to gauge the political stability and the general growth opportunities in other countries. There are several